you have a barcode scanner, like you go to the Metro, Carrefour, or Tesco, Vanguard, whatsoever. So you see, the things are bought and sold on perpetual basis, and everything has a record. So you are maintaining a record. So since this is the age of IT technology, so you are using different technology, electronic scanners. Okay, once you at the sale counter, once the barcode scanner scan the item, it automatically deleted from the inventory, and that cost transferred to cost of goods sold, and that's it. So automatically the message go to the procurement department. Okay, we have less this inventory and it's time to order a new one. So you can the procurement department, they order the goods and it's coming to the shop or the floor and selling at the same time. So everything is you are maintaining records for everything. Like I told you, two entries are going to be needed. One is record revenue and asset received, whether in form of cash or whether in form of account receivable, right? Either you can have a credit sale or either you have a cash sale. So when you have a credit sale, you increase the account receivable, you increase the sales as well. When you have a cash sale, you increase the cash, you increase the sale. And also you need to record the cost of goods sold and reduction in inventory. So reduction in inventory means reduction in asset. So asset going to be decreased, and cost of goods sold is our expense. So cost of goods sold increase being debit. So entry would be cost of goods sold to inventories, like that. So we are going to learn that what are the accounting treatment. So recording transaction in perpetual system. So let's just talk about this. We have the example here. So we don't have its illustration, just random purposes. So whenever we have sales, you need to record two entry. One is for your sales and one is for your reduction in inventory. So the inventory one is when you purchase the inventory on credit from supplier. So entry would be inventory to accounts payable. So when you sell it, accounts payable increase, sales increase as well. So accounts payable to sales. And when you need to decrease the inventory, it is cost of goods sold to inventory. So when you sell, two entries are needed. Here we go. So when you sell, number one, sale entry is going to be, so sale increase mean credit. Why? Because sales belongs to retained earning account, right? So on balance sheet equation, assets is equal to liabilities plus owner's equity, and retained earning is part of owner's equity. So right hand side of the equation, increases mean credit. Left hand side of the equation, assets increase mean debit. So sales increase, credit. And you sell on credit, accounts payable increase, asset increase, debit. So entry would be debit to credit, account receivable to sales, right? So you sell the goods, and now number of units need to be reduced on balance sheet. So the cost of those items that need to be reduced from balance sheet, that will become expense. So cost of goods sold, the expense increase mean debit. So cost of goods sold to inventory, inventory decrease, inventory is our asset, asset decrease mean credit, right? So if you transfer that entry into the T accounts, so it's going to be, so cost of goods sold is to be on credit side, and under the inventory T account, and cost of goods sold, it's a debit sign. Normal balance also debit because this is expense, so it would be like that. So we can also play with the T account of inventory as well, because inventory gonna be once we having a beginning balance, and then purchases are going to increase the inventory, so that's why it's on the debit side. So debit side, there are going to be two items. Number one, the existing balance that is coming from previous month or previous year, and then inventory is going to be increased, either you make the goods or either you purchase the goods. If you're a factory, then you are making the goods, transforming raw material into finished goods, so inventory going to increase. So how inventory is going to decrease? When you sell it. So remember, the number here is not the sales, it is the cost of the inventory. So many students, they decrease inventory with sale price, which is wrong. It doesn't make sense. It's not a logical stuff that you decrease the inventory with the sale price. No, with the cost of those goods, because inventory is recorded on balance sheet as cost price, not the sale price. So guys, you understand? Lota, Ploy, Dijodi, Kathleen, Florian, Fabian, Nimesh, Ali, Wuseong, and Anis. You getting what I'm explaining here?
Yes.
Good. Okay, let's move. So now the cost of goods sold is income statement item, so it will be written under income statement under sales, and inventory belongs to balance sheet. So the balance is now gone to the balance sheet, right? So that's why whenever you sell the goods, two entry gonna need it, and those two entries are going to affect two financial statements, income statement and balance sheet. Okay, so now when we talk about cost of the inventory or cost, the cost price of the inventory, what do we mean by the cost? So cost include everything that you paid till you receive the goods from supplier. For example, I am a company and I am ordering 10,000 bottles of shampoo, right? So I ordered the 10,000 bottles of shampoo, and I received the quotation as 60 each. So I have to pay to the supplier 600,000, right? So do you think that is my cost? No. And then I have to pay the freight charges. So sellers will, seller will tell me, okay, so you order 10,000 bottles of, shampoo. So there is like a freight charges, the cargo charges, the delivery charges. Yeah. So if I am paying that one, then I need to include in the cost of my cost of the inventory. So you add it. We call it freight in. So it means goods are coming to your premises, your factory premises or your business premises, and you are paying cash. So that is also included. That is not expense. Remember, that is a part of your inventory that is added to the inventory. Okay. And then I find out that, okay, some shampoos, the bottle is not good, not according to my standards, so I return it. So purchase, return. So that decreases my cost, right? So you decrease. So worth of 25,000 worth of shampoo are not according to my specification, and like expired or something near to expire, so I don't want it, I returned it. So we should reduce. Purchase allowance and purchase discounts. So the supplier told me, okay, if I wanted to order 9,000 bottles, but supplier said we are having this kind of like arrangement. If you buy from us 10,000, we are going to give you a discount, right? And you are eligible for us for different kind of allowances. We are going to give you free conditioners, this kind of stuff, like. So your price is going to be reduced. So I order 10,000 instead of 9,000. So I receive some kind of discount, and discount is also going to decrease my cost. So remember, this 560,000 is my total costs, and that is the value of inventory that I'm going to record on my my books, on my balance sheet. So here, wait. So this value that is written on the balance sheet. So I'm not talking about this particular example. I'm just going to tell you that, okay, in the balance sheet, inventory value 560,000 would be written here. That is called the cost price. And cost price doesn't mean that, okay, this is my order price. I order 10,000 bottles of shampoo from suppliers and 6 each, so 600,000 is the inventory. No, we need to add all the freighting charges, less all the discounts, allowances, right? So that's why it is 560,000, not 600,000 here, right? So it is written on the balance sheet in one figure, but you should know that how we calculate this, cost price, say, order price minus all the discounts plus all the additional expenses that we have paid, freight charges, right? Even commission, if we hire somebody who is, helping us to purchase things, and he has some kind of fee, that also increase my cost. That also going to be added here in the cost, right? So anything that you pay, or that that will increase your payment or reduce your payment until the goods have arrived to your factory premises, or your shop, or under your godown, wherever you start your business operation. That is your cost. Get it? Kathleen, Lota, Fabian, Ali?
Yes, I think. Yeah.
Good. Good. Okay. So let's talk about the stuff that we already talked about, and let's go into how we make entries. Though I already explained, but I explained not through the example. So let's just talk about the example here. So the journal entry to record a purchase return of merchandise, a cost 500. What does it mean? It means you are returning the inventory to the suppliers and the cost is 500. What should be the entry? So what is the logic here? So that is your inventory. So it will increase the inventory or decrease inventory?
The inventory increase and cash decrease.
Florian, think about that. The journal entry to record a purchase return. This is not the sales return. Purchase return. You purchase from supplier. You are a business. Your business is to sell goods. You purchase goods and you sell goods. You are a middleman, for example. And now you got the defective product or whatsoever. Now you want to return to the original supplier.
So is net
Your
payable?
inventory decrease or your inventory increase?
My inventory decrease and net payable.
Well done. With your inventory decrease, right?
Mm-hmm.
So tell me,